not talking about individual names, but as a sector, how do you look at that? I mean, is this a value play, or do you need to just stay away and go defensive right now?
So look, we're looking at it kind of as the cross-section. We definitely recognize that the dispersion between, more growth-oriented stocks and value-oriented stocks is, at kind of 20-year wides, and so we want to take advantage of that dispersion. So we are buying value, we are buying things like industrials, but we also want to barbell that with a more defensive posture, owning things like utilities, telecom, staples, REITs, and some of those type of stocks. When we look at things like the Caterpillar earnings this morning, we're actually not surprised, because one of the things that we've talked about with our clients is that while certainly, we think the U.S. economy is doing fine, we felt that we were going to be at a point where perhaps the capital markets started diverging from the economy as companies faced some headwinds to their earnings. And the earnings expectations after a year where the S&P 500, has been putting up numbers that are, 22 to 25% above a year ago, powered in large part by those tax cuts, would start facing some headwinds. And those headwinds could be things like, stronger wage growth, higher commodity prices, the implications of tariffs for intermediate parts prices. As well as, things like the stronger dollar itself being a headwind for exporters like CAT.
So how much of this is really a margin issue? That in fact, we were seeing margin expansion, but to some extent it's because, as you say, tax cuts. Not because people were selling more widgets or charging more for the widgets, but the federal government was giving more money back. Well,
look, I think that that's the story on the bottom line. The top line has been quite healthy so far, and that has been a function of the economy. We've been putting up, 5 to 7% nominal sales growth, which, is extraordinarily healthy, and that has contributed to that, 20% bottom line. And I guess what I would say is just now in this third quarter, and we think prospectively in 2019, we're going to begin to see pressures on that operating margin, right, where we're looking at those things like wage costs, cost of capital,
and to that point,
commodity costs.